There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery is going to be along in a moment to give us the details from today. I'm going to start with the major averages, which saw a little bit of bouncing around over the course of the session. The Dow ending the day finally in the red by more than 90 points here. Remember, we got that economic data this morning. First, we got ADP showing a gain of 37,000 private sector jobs last month. Now, most economists say that doesn't really give us a lot of insight into what we'll hear from the Bureau of Labor Statistics, the official government report on Friday. Nonetheless, markets initially reacted, and then they reacted even more when later in the morning we got the ISM services report that showed unexpected contraction in the services economies, which has been, it's by far the largest part of the U.S. economy, and it's been holding up pretty well. So that caused a little bit of concern, raised some questions about what that means for the Fed and how quickly and aggressively they will be cutting rates. The S&P 500, also a lot of intraday volatility, finishing the day almost absolutely unchanged. And the NASDAQ hanging on to some gains, but you can see they're up a third of 1%. By the way, you can see on all of the charts when that ISM number came out, a brief dip before a comeback there for the NASDAQ. Jared's got a closer look at today's action.
Yes, beware that soft data, and good thing it's just soft. NASDAQ, I'm looking at this in particular because here's a 1-month chart. It broke out yesterday to a 3-week new high, and it continued that today. It's not a huge breakout, but I think investors will take that because we were kind of in limbo for a little bit. Then I'm noticing two markets which have dropped and where that's a good thing. So the first is the VIX, which has dropped to a 2-week low. Again, this is a 1-month chart, and we can see meeting the basically May 16th, I think it was. And then the 30-year Treasury note yield, and that is down to below 4.9%, 4.89% to be exact here, another 2-week low. So that's good news for investors. That was causing some consternation last week. And let's take a look at the heat maps and see how the day's sector action panned out. XLC, that is communication services, finished in the number 1 slot, up twice what materials was in the number 2 slot. Real estate number 3, then healthcare, tech, industrials, all of those outperforming on the top row. To the downside, bad day for crude oil is a bad day for energy. Also utilities down, then staples, financials, discretionary, all of those down. So the consumer sector not doing too well today. But here's the NASDAQ 100, and you can see a lot more green than red, especially in the mega caps. Meta was a standout, up 3%. Tesla standout to the downside, down 3.5%. Apple also down just a little bit there. And NVIDIA still holding on to that number 1 market cap slot in the upper left there, and we can see that is up to $3.461 trillion. And I'll close here on the Dow and put the percentage gains for the day back on there, and we can see a little bit of a hiccup in the consumer sector, as I was saying. Walmart down 0.2%. JP Morgan slipped about 0.8%. Merck, though, up 1.5%, so bucking the trend of some of the problems that the healthcare sector has had recently with regard to their stock prices. And I will send it back to you, Josh.
Thank you, Jared. Joining us now is Jeff McLean, CEO of Solidarity Capital. Jeff has spent decades advising high net worth investors, and Solidarity Capital has over $6 million in assets under management. Jeff, it is good to see you. So, Jeff, we were talking to a CIO earlier today and asking his thoughts on the markets, and he said, you know what, this market here, after this run off those April lows, is looking kind of stretched, he said. We're a bit extended. Wouldn't be surprised, he told us, to see a correction coming. What do you make of that argument?
Yeah, I don't share in that. I think the volatility is going to continue. I mean, whether it's the daily True Social post or the economic data that scares things temporarily. But I think from a long-term perspective, the worst is behind us for the year. I think the extreme volatility, as was just shown with the VIX, right, is behind us. We're at 23 levels at the VIX is really nothing to worry about. So I think this summer, volatility is going to be a bit more muted as people kind of check out of the daily news that's been triggering a lot of the tariff-related news associated with it. And we're really hopeful going into year end. I think it's setting up well for a lot of the broad-based market to have some strength going into year end, especially those Mag 7 names who maybe got hit more with the tariff talk.
Jeff, I understand, and this is what a lot of investors have been saying, that the worst is behind us in terms of the tariffs, or we've avoided the worst case scenario. Right. But what about the flip side of that? What's actually going to go right? I can see that things maybe aren't going to go terribly wrong, But do we have to see some more positive catalysts, actually good things to happen for stocks to rally from here?
Yeah, that's a great question. So where we were earlier, just about a month and a half ago, consumer sentiment, CEO sentiment was incredibly negative, like some of the worst it's been since 2008, 2009. You're seeing that shift back to either more neutral or even some a greater strength and bullish for the end of the year. I think that's going to be one of the catalysts, is the sentiment around both consumers, which will reflect in spending, and then CEOs, which will reflect in CapEx. I think you're going to see both of those continued shift away from very bearish to much more neutral or even bullish going into year end. I think that's going to help in a variety of fronts from an economic perspective. Not to mention, any little bit of cut we get from the Fed is going to boost psychologically the consumer well from a sentiment perspective. If the Fed does what many expect it to do and get a cut later this month, I should say.
And Jeff, I was going to ask you about your expectations for the Fed, because I was wondering, to the extent that we see maybe some softening data here, and you saw what we got today, ADP and ISM services, they both came in below consensus. But at the same time, these inflation prints have been clocking in relatively tame, Jeff. Do you think that gives the Fed more room, more comfort to make those cuts?
Yeah, I think they have the data to support a cut. I mean, the tough part with the Fed practically is they're in a difficult spot. Even if the data supports a little bit of cuts, because of the political pressure that they're facing, it also is not great to be able to, where it's viewed externally as them giving into that political pressure. So they're in a very delicate spot. And what I'm kind of curious to see is not just the interest rates cut, but what they're doing on their balance sheet. Are they still moving forward on unloading the balance sheet? Do they take a pause of sucking liquidity out of the system? Because that's a dual issue right now with high rates and reducing their balance sheet. And so it'll be curious how they use all their tools, not just the interest rate cuts, to maybe ease things into the economy.
Jeff, what are your clients worried about right now, or what questions are you getting most commonly?
Yeah, I think most commonly it's the volatility. I mean, the fear factor. 23 and 24 were pretty smooth rides. I mean, it was a pretty up and to the right. Everyone loves that. Everyone's happy. This year, the volatility has made people nervous. The fear around the tariffs and the drastic nature of that, especially around China, and if you're a small business owner sourcing products from there, it has been a nightmare for you. So I think it's all really tariff related and volatility related. As that's been easing, there's been a lot more comfort, a lot less stress about it in particular. But the question that continues to happen is, hey, is this leading us into a recession or not? And that is probably question number one with the volatility is, hey, is this all leading us into a recession, or are we going to be able to turn it around between the Fed, Congress, and the economy and businesses themselves spending money?
Finally, Jeff, let's talk about some opportunities here. Give some people some names to think about. One name you like, Jeff, Novo Nordisk. Now, that stock has been shelled. You like it. You see an opportunity. How come?
Yeah, we've liked it, and from a buying at the low perspective, is you have this great business, and it's basically back to 2022 prices almost, right before they came out with the weight loss drugs. And so when you're looking at this business, has significant growth from the diabetes or insulin part of its business. And that was the valuation of it back in 22 prior to the GLP-1 craze. And so you're basically getting the diabetes and insulin business, that's what you're buying, and you're getting a free option on the weight loss side because of the extreme drawdown, 50% year over year drawdown in this. And so we're bullish on it. Now, they have to clean up the CEO situation. Obviously, a sudden resignation from the CEO, they need to find a replacement. But we think they're very well situated to continue to ride this out, continue to create market space for them and protection in the GLP-1 space for a long time to come. And so I think from a valuation where it is today, price to earnings ratio, free cash flow, super appealing as a buy today from our perspective.
Jeff, always great to see you and to have you on the show. Thanks for joining us.
Yeah, thanks, guys.
Well, coming up, HPE CEO Antonio Neri joins the program to break down the latest earnings and the path ahead for that company. Stick around, much more market domination overtime. That's still to come.
Shares of Hewlett-Packard Enterprise have lost more than a fourth of their value this year, but shares of the data center equipment maker rising now on recent developments. Our Brian Saucy sat down with HPE CEO to discuss.
All right, we're keeping a close eye on shares of HPE after better than expected earnings. Let's bring in HPE CEO Antonio Neri. Look, I was in the seat, I think you were in that seat 3 months ago, talking about challenges in the server business. Has this business, did it bottom in the most recent quarter?
It did. But look, Brian, we had a very solid quarter. In fact, we delivered above our commitments for the quarter, including the server business, which we provided a guide that ultimately results came at the very high end of that guide, both on revenue, operating profit, and operating margins. But what I'm really pleased is the fact that we took swift, targeted, and aggressive actions to address the three challenges we discussed last quarter in the server business. But this was our fifth consecutive quarter of year-over-year revenue growth across the company, and every product business in Intelligent Edge, in networking, hybrid cloud, particularly through storage and GreenLake and private cloud, and then server grew revenues. And then we also expanded profitability in hybrid cloud, HPE Financial Services, and Intelligent Edge. And we are on track to deliver the server operating margins back to 10% by the exit of Q4. So all in all, strong performance. And because of the momentum we saw in Q2, the line of sight we have for the second half, the bigger pipeline we exited Q2, we are raising our bottom range of that EPS guidance, the non-GAAP EPS guidance, by 8 cents.
The margins, the operating margins in the server business, down year over year, down sequentially or quarter over quarter. You, in the trenches here, what are your teams seeing? What has been making it so challenging in that server market?
Well, first of all, like I said, we delivered better than expected, although we guided down quarter over quarter. And like I said, it will take 2 to 3 quarters to get back to that 10%. But it's a combination of things, right? One is what we discussed last quarter with some inventory issues that we had to take care of it, aggressive discounting. But ultimately, it comes down to the mix of the business with AI. And that's why we take a very disciplined approach across the AI ecosystem, if you will. And what I'm really pleased in AI is that this quarter, 1/3 of our orders came from enterprise. We tend to come with a higher margin because there is more software and services attached to that enterprise market. Then you have to pay attention also to working capital. Working capital is very important because in some of these deals, you are deploying a significant amount of capital, and there is a time between the capital deployment and the revenue and profit recognition. So that's why it is a technology transition, there is a business transition, and then there is a working capital transition. But I'm pleased with the progress we've made in Q2. Definitely was the lowest, and although better than we anticipated, and we have our way path back to where we need to be.
When I talked to Enrique Lores, who you know, of course, Antonio, he is the CEO of HP. They reported earnings, disappointing quarter from them. Sounded cautious on the outlook. Maybe enterprise consumers or businesses are holding back demand or orders because of everything going on in the economy. Heard the same vibe from your competitor over at Dell in the server market. Have you started to see concern from your customers, those business customers, about placing orders, given everything that's going on in the world?
Well, look, because of a unique portfolio, and we have a very comprehensive portfolio between networking, and we are excited to see the transaction with Juniper come to a close very soon. And then, the hybrid cloud with GreenLake. Look, GreenLake grew 47% year over year, driven by the stickiness of that experience through storage and private cloud and all the ancillary services. And then our server business, which is a very large business. We have actually the ability to mitigate ups and downs, but I want to tell you the demand during the quarter was steady. Although it was uneven through the weeks because of the tariff churn that we went through. But month 3 was very solid month. And like I stated, our pipeline was higher in Q2 than it was in Q1. And so from my vantage point, customers continue to invest in IT. They all realize without IT, you can't compete in any industry you are in. And so that's why I'm more optimistic than just thinking PCs or printers or anything else. We play in the right market, and we are capturing some of these inflection points we see.
Last time I talked to you, Antonio, you announced a workforce reduction, 5%, $350 million potential cost savings. But on that earnings call last night, I heard a maybe more aggressive HPE than I thought. Are you going to go deeper or beyond $350 million in cost savings?
Look, our goal is to accelerate growth while we drive structural cost savings, right? We are not only reducing costs, but rethinking how we become more agile in the way we operate. So we are on track to achieve our overall $350 million cost savings by the 2026 fiscal year. And we made significant progress, and we expect that will continue to the future results. Obviously, actions impact our employees, our team members. We don't take those lightly. But the reality is that we are focused on anything that will drive operational efficiency across the company. So aspect of that may be portfolio rationalization, but in the end, it's about process simplification and automation. And look, I think we spoke before, the fact that we have more than 250 use cases where we are doing POCs, already deploying AI, in fact, more than 40 already in production. And we see the benefits of that across finance, global operations, marketing, as well as services. So that's why we believe there is an opportunity to accelerate that improvement, not just by reducing the workforce, but really become nimbler and better at everything we do.
You mentioned Juniper, Antonio. That trial begins, I believe, in July. And I've been following this with you every step of the way, ever since you announced this transaction. Now, you remain confident you can get this deal done this year. Are there concessions you're willing to make to the administration to get this done? And if so, what are they?
Well, look, the trial will start on July 9th, and we believe it's going to last only 1 to 2 weeks. That was the direction of the judge. So that's why we are now closer and closer to that timeline. And then the judge may take 2 to 6 weeks to issue the opinion, but that's the court process. And nothing has changed in our confidence to get the deal done. As we said many times, we believe the DOJ thesis is flawed. They narrow the market in ways that really is not right. And second, it's not the reality, by the way. In the United States, when you think about the Wi-Fi, the wireless market, there is at least 8 competitors that they're all playing in every segment of the market. And then, through the documents we have access, we believe we have the right to win this case. But we obviously, talk to the DOJ on an ongoing basis. But if they come forward with something that makes sense in terms of a proposal for settlement that does not change the thesis of the deal and the return to our shareholders, we will consider it. But right now, we haven't seen that.
Coming out of this quarter, Antonio, and I was surprised by this number. We're just crunching the math. Almost $12 billion in cash on your balance sheet. That's about 50% of your market cap. If this Juniper deal does not go through, what's your next course of action to drive shareholder value?
Well, look, Brian, the reason why we have that balance sheet is because we are ready to pay for the Juniper deal. And as you recall, I stated that the Juniper deal is not only the fastest way to generate shareholder value, but we are committed to deliver at least $450 million of synergies, which pay for more than the deal itself. So this is a no-brainer from a financial architecture perspective. From a technology perspective, this is totally complementary to our Aruba networking and the rest of the HP portfolio, which will allow us to provide a modern, secure AI networking set of products and services. And outside the United States is to compete with other vendors, including Huawei, which obviously they have a larger share because they are not allowed to play in the United States. So from an investor perspective, it's a great deal. From a customer standpoint, it's a great set of technology and talent that we can integrate. But look, we looked at multiple alternatives with our board. It's our fiduciary duty, how we accelerate value, and we landed on this one. But if this doesn't happen, which would be incredibly disappointing, then obviously we're going to discuss what is coming next. And there is a number of scenarios, including capital return and the like. But we're not prepared to discuss those at this point in time because our focus is closing this transaction and going through the trial.
Since we last spoke, Antonio, the Elliot Management, of course, a feared activist investor, has reportedly taken a $1.5 billion stake in HPE. Have you been able to meet with them yet to hear what they had in mind or suggesting for your company?
Well, Brian, HPE and our board maintain an ongoing dialogue with shareholders, and that has to do with a range of issues, and we always value their constructive input. We don't comment on specific communications that we have had with our shareholders, but as you can imagine, our board is very engaged. But I don't speculate on anything at this point in time. Is
an activist helpful or hurtful to what you're trying to do in terms of transform HPE?
Look, we welcome all the ideas, and if there are really ideas that we haven't considered in the past, of course we welcome them. And that's why we always approach every conversation from a constructive standpoint. Look, we have very smart investors, and Elliot, of course, is one of the smartest out there. So we approach this in a constructive way. And so if they are ideas that will accelerate the strategy, the value we are focused on, of course, we'll consider.
All right, we'll leave it there for now. HPE CEO Antonio Neri, always good to see you. We'll talk to you soon.
Thank you, Brian.
BlackRock getting back in good stead with a key Texas official after retreating from environmental, social, and governance initiatives. For more, let's bring in Yahoo Finance senior legal reporter Alexis Keenan. There had been a bit of a fight between Texas and BlackRock.
A 3-year-long fight, at least, and it was out of a Texas law that banned the state funds from being used to invest in companies that were antagonistic to fossil fuel production. So Texas has had on this law in the books, passed in 2021, and BlackRock has been dealing with it, as have other companies since then. Specifically, the law states that investments from the state's coffers cannot go to companies that harm, penalize, or limit the industry. So now these Texas pension funds and other funds from the state, they're going to be able to be used to buy most of BlackRock's products. There are some funds that don't qualify still, and they're still on that blacklist. And this all, of course, comes after the CEO, Larry Fink, had disentangled BlackRock from a number of climate initiatives, two specific ones that the comptroller in Texas cites to in doing this pullback. In a statement, BlackRock said to Yahoo Finance that it's proud to help millions of Texans retire with dignity, and on behalf of clients, invest over $400 billion in corporations, local governments, energy infrastructure, all throughout the state. A report from the Wall Street Journal has said that the law did indeed lead Texas to pull what they say billions. They don't say how many billions. We've asked as well. From its investments. So this will change things significantly. They're still big numbers, despite it being probably a drop in the bucket for BlackRock. It's still a lot of money when it comes to Texas. So at the same time, you have an antitrust suit, though, on the other hand, going on. That is a Texas-led antitrust suit, and it alleges that BlackRock and Vanguard and State Street collectively got together on an ESG initiative to reduce the production of coal, and so they say that harmed consumers. So you have kind of two messages going on there, and the FTC and the DOJ have also sided with the states in this matter.
All right, important story. Thank you so much, Alexis. Appreciate it. Time now for what to watch Thursday, June 5th. Starting off on the earnings front, we're going to be getting some big names tomorrow. That includes Broadcom, Lululemon, and DocuSign. Broadcom announced results for the second quarter. That's after the markets close. Analysts expecting a strong quarter for the company, driven by rising demand in AI, especially in its networking chips. But gross margins could be under pressure with wireless and software segment growth stalling.
Taking a look at the Fed, some more Federal Reserve commentary coming in the afternoon from Governor Adriana Kugler and Fed President Patrick Harker. This comes after comments from Fed Governor Lisa Cook yesterday. She expressed concerns that tariffs are raising inflation and complicating interest rate policy.
And switching to Nintendo, it is finally here. Nintendo releasing its long-awaited Switch 2 console at midnight tonight. It's the company's first new gaming console in 8 years. The Switch 2's base price set at $450 in the United States. And despite President Trump's tariffs, Nintendo has held steady on the console price, but announcing price increases on Switch 2 accessories like controllers and carrying cases.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.